So my name is Darson Grantham. I'm a real estate agent here in Des Moines at Keller Williams. And on these episodes and this podcast or YouTube video, depending on what way you're watching it, we like to just go over what's going on in Des Moines and then in the Des Moines real estate market, and also just educate. So with that, I'll introduce co-host Jared Huseman.
Jared Huseman here, president of the Catalyst team at KW Commercial Realty. We're a multifamily specialist group here based out of Des Moines. We operate across the state, and just kind of bringing the commercial multifamily perspective to this podcast, this view, whatever you're watching here, just kind of give a perspective on it. Yep.
So in these episodes, we kind of go through the news of what's happening in the market in general, and then maybe some specific deals that we've seen maybe closed on, and then some strategy. So let's start off. Let's just kind of talk about the news. And when Jared and I were talking this morning about what topic we were going to talk about, obviously interest rates was something that came up, and Jared said I could talk an hour on interest rates, and so we're just going to let him talk.
Yeah, so it's a joke, but I mean, interest rates are going to affect, for our market, the investment commercial market, I think, more than any single family homeowner or consumer. And I mean, that's been the huge talk right now. I was just talking to a buyer literally 5 minutes ago before I came in here for our podcast here, getting quotes at 4.5% interest rate. And 4.5% when we were talking about 3.5% 45 days ago. I mean, this is huge. The interesting part for our market so far, I just wrapped up our quarter report for the Catalyst team and our sales volume, sales numbers, average cap rate. As of the first quarter, 6.5% average cap for multifamily for Des Moines. The interesting part is that the market has not caught up yet to the interest rates. Buyers are just in the last 2 weeks starting to demand these better cap rates, but the sales volume hasn't hit it yet. So if you're watching this, just be on the lookout. The next 30 days are going to be very transitory compared to what the last 30 days have been and what's already closed.
And for a 6.5% cap rate, that's up from or down from 7.25% is what it was end of last year, right? End of 2021. Just to give a perspective of where it's going, it dropped, and we'll see what that does here after Q1. So cap rates in 2021 were, Jared runs a really good report, and it was around the 7.25% cap rate on average across all the deals done that he's tracked in 2021. And so what Jared just said was his Q1 of 2022 is the cap rate is 6.5, right? So what that means is properties values have increased. People are willing to pay more for a lower return.
Slightly. I mean, as of 2021, we saw 6.83% was the average cap rate. We saw that trend down to 6.5% cap rate last quarter. Now, I want to give a preface. This is not 100% accurate information. There were a couple sales I wasn't able to get the information on and confirm everything. Again, I'm going to talk from commercial's perspective, multifamily for our state.
And the reason is the commercial world, and Jared, correct me if I'm wrong, the commercial world it's not tracked in totality near like the residential is. Now, residential still has its one-offs that are not tracked through the MLS, but there are 3,000 agents in Des Moines that are tracking the single family. On the commercial side, there's a lot more deals that are done percentage-wise behind doors but that are not, on your Crexi, on your LoopNet. They aren't in the public eye. They're just on maybe the tax assessor website. So Jared's team, from my understanding, is he's going to go just track all of those transactions as they come across.
So that's actually a really interesting point, Darson. It actually brings up a really interesting point. I think that's a big difference from whether you're in the residential market or even the residential investment market to the commercial market. A big difference is just how opaque it is. So a lot of deals in commercial are done off market, pocket listings, etc. You can't always track those sales. And just honestly, from a peer's perspective, the difference of mindset is, and most of the time, a homeowner doesn't care if someone knows who owns that house, who lives there. From a commercial perspective, many of these owners of commercial real estate want to hide their assets. And they're not trying to be malicious, they're not trying to be anything negative, but they're trying to have different LLCs to mitigate their liability standpoint. And it's just not good practice to know Joe Smith owns a principal building downtown and he's worth $100 million. And it just creates a big target on your head. So commercial is a lot more opaque. So it's always hard to get our information. We don't have the resources for data like we do in residential. So it's really important to have an agent or a team or someone when you are doing commercial transactions who really knows the data and the numbers and can dive into it for you. Because a lot of these systems, CoStar, Crexi, they miss a lot of things. And we just don't have the data like residential does.
Right. I mean, I sent you a PDF yesterday of, was it 10 units that sold in Ankeny. I said, hey, Jared, did you ever know that this was even for sale? And
Yeah, I didn't even see it, and it was already gone. And I had a buyer for it. I mean, the moment I saw it, it was like, yes, this is it. But it just doesn't hit like everything else does. So commercial is just a little bit different in that perspective of how things work.
Yep. Okay, so back to interest or cap rates compressing a little bit in Q1 of 2022. So that's not really taking into consideration, I think that's the point you're making. It's not taking into consideration what the interest rates have done, because folks that closed January to March in 2022, they already had their rate locked in for their closing. So a very true indicator will be April to June.
And I think this is an interesting part. Me and another agent had a discussion on the other day. I think it's super interesting, is when we're looking at just the commercial market, which both of us tend to play in a lot. It's investment real estate, whether it's a house or it's an apartment. The financing is very different. The interest rate's very different. The interesting part is that the consumer market, the average home, will dwarf the commercial industry. No matter how big commercial is as a whole, the consumer market will dwarf it. So the question...
The volume or the number of units? Or both?
The volume of consumers will dwarf the commercial market every day. So, and I mean, so for a reason, is that we're going to see the slowdown in commercial lending and commercial pricing, whatever it may be, at this point, because interest rates faster than residential market will, because consumers, they still have jobs. The job market is crazy robust right now. People are getting, increases in their salary, inflation, wages, whatever it is. They can afford a half a point, a 3/4 point, or maybe a point, difference in their interest rate on their house, and it's an emotional transaction. An investor who already had slim margins, had very tight compression over the last 18, 24 months, coming out of COVID here, they can't afford those interest rates like the average consumer can. So I believe they're going to start demanding that better cap rate. The interesting part is going to be when the consumers start demanding a better price. And that is what will potentially drive us into a recession, is when they do, or if they do. I don't know if
you mean on a residential purchase?
Yeah, on residential purchase. I think the consumer and the resident, when that homeowner says, I cannot afford this property at 5.5, but I could at 4.5, I think that's when we start seeing the real slowdown in the real estate market. From my perspective, if you want to...
Well, I struggle with that is well, Gary Keller did this in his 2022 vision speech. He showed what the percentage of folks' income was in 2005, 6, 7, 8 that they were paying toward a mortgage versus now. And really, it's been at the 15% mark. And the only time it was unaffordable was back in the 80s when the interest rate was up in the teens, right? So and that was when it was above 20% of your household income was being paid toward a mortgage. Right now we're at 15, and the way to bridge that gap from 15 to 20, like there's a lot of room to go before people are paying, on average, more than 20% of their take-home income toward mortgage. And so that's, to answer that question, the fact that there's such a big gap there, I don't see the interest rates affecting the residential market.
I'm gonna dive into this here from a pure perspective, devil's advocate here, just for fun. I want to hear your thoughts on this. That is purely from an interest standpoint. And this is something that Gary Keller talked about in his Gibson feature, which we broke down in one of our videos, is that is only when you look at the principal and interest on that mortgage. Now, the interesting part is he said that Canada runs their numbers as all-inclusive of what it takes to maintain that property, the taxes, the insurance, the principal payment, and the mortgage interest payment, all of those things. And so Canada runs their numbers a little differently, and that's why those numbers show differently stats. So what you just said is interesting, because you said that we've got a long way to go for interest rates to make up for that payment, for that 5%. The question I become, especially here in Iowa as well, property taxes. If anybody has property here in Iowa, you've seen your property taxes jump up from residential to commercial. Everybody's seeing it. I want to know what interest right now, or insurance is going up right now, and then just the cost of maintaining your house. If you can get a plumber to show up for less than $6,500 an hour, I don't know if anybody on this, if you have them, let me know in the comments, and I'll call them right now. Because it's just the cost of labor is going up. So the interest rate perspective is one piece of that pie, but I'm curious to look at from a homeownership perspective, from an investor's perspective, the other cost of maintaining and owning that property.
And that goes to the consumer price index that's tracked by the government and can be manipulated in any way that they feel so pleased to do so. Let's not get into that.
Right.
But there isn't an answer. So basically it comes down to the the ticker that I'm tracking to see when the market is going to fully shift is days on market or months on market, right? So when a property starts averaging on market 4 months, or no, there's 4 months, 4 months of inventory on the market, like that's the ticker. So there's 3 months during COVID, 2020, March, April, May, where there was about 4 months of inventory on the market. And that's when 21 million people lost their job, right? In 08, 9, 10, that downturn and recession, there was 10 months of inventory, and the same number of people lost their job, 21 million, right? So to me, what that's saying is our economy and housing market sustained 21 million people losing their job, and there was still only 4 months of inventory in the market, where the worst recession we've ever had, well, not ever maybe, but it was 10 months on market, right? So I don't have an answer for you. We'll be continuing to track it. I think residential will be impacted significantly different than the commercial world.
Well, and I think this ties up a huge thing that I've had discussion about, and it's honest to God, this is what I tell my clients this, so this isn't going to behoove Darson here, but I think I see more room for price increases, rental increases in the residential market in single family and SFR than multifamily and commercial right now. I always have. And I'm going to hit it from a totally different standpoint, is just the simple supply and demand economics. So people forget in 08, we lost a ton of home builders who were building spec. And if you talk to home builders who lived through the 08, 09, they all say, I'm not getting over my skis again, I'm not overbuilding, I'm not going to leverage as much as I was. So they've been very cautious. So cautious building, high product type. I mean, right now lumber and the cost of building is going up. And at the same point too, we have on the interspectrum the millennials who are just aging into that first, second time home buyer market right now, mostly second home buyers even. And they're the biggest population demographic since the baby boomers. The last time we saw this much housing product develop was the 60s and 70s with the birthplace of the suburbs. So from a sheer supply standpoint, the supply is down because we don't have enough product, we don't have enough developers, and the demand is through the roof. So that's going to keep pushing the SFR market, I think, up. And that's a great reason why I think still to be in single family housing or even multifamily is because, again, if you're going to see those prices keep ticking up for housing, I can't afford to buy, I'm going to continue to rent. And I think that's the interesting part we're talking about, is at what point do homeowners just continue to buy because I want to own a home and build equity, which is number one path towards wealth, or second, investors from our standpoint, whether it's houses or apartments, are going to just factor in growth. They're going to factor in, I'm buying this at a low cap rate and the yield might be low, but I'm factoring the growth rate of that because I see this huge demand coming in a short supply.
Yeah, I can't disagree. We'll see.
As we're talking here a lot about interest rates and cap rates and the yield and what's going to happen, this is not exact science here. This is part art, part science. But one thing that we've been tracking and seeing as a team as well and watching is, generally speaking, for multifamily, we're still a hot sector. We still have a lot of investors who want to bone this for the growth, for the rental, etc. What we're seeing is that for every 1 full point of interest rate tick up, we're seeing about a half point go up in the cap rates.
Okay.
So I just released my quarter report for our team, to our market here. If you'd like to get on that, email us, comment, we'll get you on that review so you can see our quarter report of what we're seeing in the market. But I just checked it. Interest rates were up a full 1.1% in the last 3 months since I released the last one in the first quarter of the year. So following that trend, assuming that's accurate, we saw a 6.5% cap rate the first quarter. If that follows 1 to a half ratio like we're talking about, in theory, the second quarter we can expect to be at 7% cap rate average forthcoming. Because again, we see about a 1 point rate, half a point cap rate increase.
Is that industry standard, or is for every 1 point of interest rate increase, half a cap rate, is that a national standard? That's
a national, yeah. So that's pulled from the national standpoint. It'll be interesting to see how much that affects. So that's national, but the growth markets that we're all seeing, the Austin, Texas. I mean, let's be honest. I mean, the Floridas. Are they really going to see that? Probably not. What's going to happen is some bank's going to come out and say, I still like this and I want to be aggressive on it. I'm going to compress my fee a quarter point. If the buyer's going to compress their fee a quarter point, we're going to make up the difference. So you're going to see, I think, the lenders and the buyers compress that, or maybe a mixture of lender, buyer, and seller. Maybe seller comes down, 0.175, and then the lender meets it that way, and so does the buyer, and everybody kind of wins, and they figure out that process. So that's just a national standard. Again, if you're in a hot market or growth market, it's going to be different. But In theory, we should see cap rates tick up to, again, a 6.75, a 7% cap rate. The interesting part to this is, as we just talked through the problem here, we're coming into the spring market, and spring markets when everybody raises rents. So even though we might see a higher cap rate, we might still see price per unit and sales volume and sell price per square foot all be still higher or the exact same, because now the landlords are all raising their rents. I have talked to, out of all the owners I've talked to in the last, I'd say 2 months, and I've been asking the question consistently, have you raised your rents? Have you raised your rents? Very consistently, I'm hearing yes. 10% across the board almost, which is ironic because 4 months ago, I can tell you, asking the same question in the fall and the winter, nobody had raised rents. Nobody was doing it.
Because it was fall or because of the economy?
I think there was still a little bit of a fear. We were just getting through the eviction moratorium that ended in the fall. I think it was winter. I think it was one of those things a lot of owners don't want. They want to keep just occupancy rates. But I think as we've really seen inflation stick around, despite what the Fed may want to say, as we've really seen these inflationary trends keep hitting and owners continue to get these bills for utilities, for taxes, for repairs and maintenance, they're just saying, I can't do it. I have to raise rents. I've been trying to eat the cost as long as possible, but I have to. So I think between the timing of the market, the inflation, and just what people are seeing, they're just finally, it's the straw that broke the camel's back.
I think that there's a huge opportunity for landlords to increase rents right now if you have a decent property. If you have a nice property, you can demand a rent that is unheard of in the market. I've seen investors do it. I've seen owners do it. And tenants are willing to pay and stay there. Like last week or 2 weeks ago, 60 Minutes did an interview on a couple down in Florida now. Obviously not in the Des Moines market, but they did an interview with a couple that they were getting a $400 a month increase in rent on their single family house. And they just thought that was just the craziest thing ever. And the interviewer I was super excited that the interviewer asked them, did you shop around? What'd you look for? And he said, yeah, I looked at 100 other places. Everything was higher than what we were paying for a like product. So what that tells you is landlords, you have the ability to increase rents without your tenants leaving. We all know vacancy is one of the biggest costs that investors have when you own a property. Like, it's biggest expenses. So nobody wants, like, we both own properties, nobody wants to have vacancy. Even if you know it'll get filled in a month, vacancy is not any fun. It costs you a lot of money. You can still increase rents and not lose your tenants right now. It absolutely can happen.
I love it because honestly, and I agree, like, everyone knows vacancy is the #1 destroyer of wealth in real estate. It's just how it is. However, I love what you just said because it's so true. Let's tie back to what we said earlier. People are getting raises. The job market's strong. You can afford to raise rents, and especially if and do it in the right way. Here's the thing too: if you want to raise your rents, go to your residents and have pre-populated their comparables, and don't do it in a malicious way. Don't just show here's the top of the market and that's all you have to search from. But if you realistically are watching apartments.com, watching the Facebook marketplace, watching what's going on in your market, and you can realistically go to them with one sheet of paper and show 3 to 4 comparables in that market that are all demanding higher rents and are a nice product or similar product even, you can very easily raise the rents and they will be okay to pay it. I think there's a common theme sometimes we think as landlords that our residents are just evil and they don't want to pay their rent. The ironic part is, talking to most of my clients and landlords as well, we all agree that actually residents want to pay their rent. They want a nice place to live that's good quality, they can feel safe and call home, and they're willing to pay a good rent for it. And if you just treat them like people, they're gonna be great to you. And honest to God, we can all say this, I hate tenants too, we all hate tenants, but when you actually boil it down, 90% of tenants are good people. There's only that handful, that 1 out of 10 that's a trouble, maybe 1 out of 20 for that 5%. That's hence the vacancy we've had for years historically. But generally speaking, 9 out of 10 people are good people. Treat them fair, give them a good product, show them their comparables, and you can raise your rents. And don't feel bad about it. That's the other thing too. I have so many owners who say they feel bad. Well, okay, you can feel bad for your resident until you're being foreclosed upon, or you're not making the return you want. Or if you want to feel bad for them, this is a joke for all you men out there, go tell your wives how much money you're giving up to let your residents have a happy life. I guarantee you your wife will get on you to get your rents raised. 100%.
I don't know.
You don't know?
There's a lot of softies out there.
I don't know. In my experience here, this is going to be a little off record, but for any men out there, get your wives involved. This is actually a theme I give to a lot of my investors. Get your wives involved, in my opinion, because they are better negotiators than us. and a lot of them want to help and be involved. That's my personal take. At least get them on board what you're doing.
Oh, on board. My wife does not.
Some don't.
Does not want to be involved. So, know your spouse.
I think this comes back to, though, no, I will say this, though, one of the key factors I always have when you are investing, this is a total segue, but talk to your spouse, at least make sure they're on board. Maybe they're not super excited about investing, maybe they don't want to know about it, but you got to have a spouse on board with what you're doing.
Absolutely.
If you don't have that, you're already trying to climb frickin' Mount Everest.
I think that goes to anything, whether you're investing or you're buying a car. I'm a huge follower of Dave Ramsey. Although, basically, once we get to baby step 4, I cut that off. But his motto is you guys are a partner. So a spouse, you guys make all your decisions together, right? So I absolutely believe that if you're going to invest in real estate, you're going to buy a car, you're going to buy gold to put underneath your mattress. You need to talk with your spouse to figure out where you're on board. Budgeting, spouse should be on board with that. I'm
just going to keep coming back to rental increase, though, just tiny background. I will still say, if any gentleman out there or any owners out here break down how much you're losing every month by not having either at market rate rents or slightly below it. I'm going to use a stupid example. Let's say you have 20 units and you are just $50 below rent. That's it, just $50 below where you could be. This isn't top market, this is just where you need to raise $50. Go to your wife and say, honey, what would you do with $1,200 more a month? It's basic math. And if she says, well, why do you ask? And you say, well, all my rents in my apartments are $50 below rent and I'm $1,200 less a month. Ask how she says it. Now, she might say, I don't care. She might say also, get those things raised immediately. Or maybe she says, get them raised $600. Let's be nice to them. I don't know. But again, the point becomes, start looking at what that money can do for you. Don't be upset you're raising rents. You can do it right now and you deserve to. You all have a property. As long as you are putting money back into the property.
Right.
Pause here. I want to hit pause here. As we talk through all these things we're talking about, high interest rates, we're talking about days on market, we're talking about what's coming forward. One thing I want to talk about a little bit to anybody out there is how do you make money? How do you pivot from this? What do you do? So what we're talking about a lot in the commercial world across the country is a shift. We're starting to see the shift coming. We're starting to see just the softening. Now, does a shift mean we're going down and it's a recession and let's nosedive this plane? No, but we are seeing a shift in the market. As always, when you're going into a shift, just make sure a couple things are happening. And the biggest two things, make sure your cash reserves are well supplied and make sure your cash flow is on point. So double check your cash reserves, double check your cash flow, because those two things are always going to carry you through any recession or any shift in the market and ultimately help you thrive coming out of it.
Yep. It's investing 101. And if you've only been investing for the last 3 years, investing 101 makes no sense. It just doesn't. So investing 101 is have a reserve account, make sure your cash flows above mortgage costs and above to cover your expenses, right? And then above that, you can pocket away and consider it income. Although most investors, unless you're a full-time investor, most of us investors are putting all of our rental income into a bank account and holding it for the rainy day or the next purchase, right? So that is investing 101. What we've been doing for the last 3 years, I've done it, I don't know if Jared's done it, but I know a lot of investors have done it, is you're speculating because there are good signs that give the idea that the market is going to be good in the foreseeable future. We're starting to see that change. That's what Jared's saying. Mm-hmm. There's a shift, there's a softening that maybe things aren't going to go quite as well as they have for the last 3 years. Doesn't mean it's tanking, but it could mean it's not going to be appreciating. It's not going to be as, landlord, owner, buyer, seller friendly.
Yeah, at the end of the day, I'm just going to equate this to this, is that, I'm going to make a weird example here, maybe a weird analogy, but if you are going for a run, and let's say you're going to run, however long it is, 10 miles, 13 miles, whatever it is, at certain points you're going to stop, maybe check your pulse. Where's my heart rate at? Am I doing the right things? Am I in the zone? Am I going too hard, too little? You're going to try to adjust, maybe you're running, wherever you're at, to make sure that you can make the distance, or you can get things done. Do the same thing with your investments. Just take a moment if you haven't yet, pause, sit down, review your T12. That's the one thing most owners don't do. Review your T12. Review how your T12 operates to the year prior to that. So just on review 2 years of financial information, and then review your cash reserves, and just ask yourself what would happen if maybe rents stay the same. I think rents are going to be okay. But what happens if interest rates tick up another point? Can I afford this? Really sit down and just look at, can you afford a major repair right now, and what would a major repair cost? So just sit down, check the heartbeat of your business, because we're coming into a shifting market.
So we'll wrap this up. Again, my name is Darson Grantham, and this is Jared Huseman, and there are ways to reach out to us. We have information below. Jared has a really good quarterly email. I have a weekly email that goes out. Mm-hmm. I have a YouTube channel that is viewable. Jared has a YouTube channel that you're able to subscribe to.
We're building.
Yep, that we're building, right? And so if you want to just be in contact with us, reach out. We're happy to help. And whether you're a buyer or seller, or just looking at the Des Moines market and trying to figure out what it's all about, we're happy to have that conversation.
Yeah, I guess just as a final tag for me, I'll just say we're really accessible guys. I mean, whether it's social media here, Google us, click below, follow us, whatever it is. Leave some comments as well. Happy to have it. But just ask us questions. We want to be here as a resource for you guys and all your investments.
Cool. Until next time. We'll see you.
See ya.